All right, let's get right to it. The market is screaming strength right now, but underneath the surface, it's setting a trap. We're going to break down exactly what that is.
Most people, they look at the S&P 500 hitting these incredible all-time highs, and they think, well, the economy must be rock solid. And honestly, that's a perfectly logical assumption. It's also become an incredibly dangerous one. And that's because that very belief that all-time highs equal a strong economy is now the bait in the trap. There's a deep structural break happening right under our feet, a divergence that the wider market is completely ignoring. And here it is, the whole conflict on one screen. On the left, you've got financial assets, paper wealth, just soaring to the moon. But on the right, you have the physical economy, the part that actually makes stuff and moves goods around, and it's slowing down. This gap, this tension between paper and reality, simply can't last.
So stick with me for the next few minutes, because by the end of this briefing, you're not just going to understand this divergence. You're going to see the signal it's sending long before it ever hits the front pages. So what's the actual trigger? Let's dig into the hard data, and you'll see pretty clearly why this isn't just market noise. It's a fundamental shift. We're seeing real cracks in the foundation. I'm talking about things like heavy truck sales, a fantastic proxy for how many goods are actually moving across the country. They're down. And housing transaction volume, a key measure of the consumer's financial firepower, that's falling too. Look, this isn't a forecast. This is what's happening in the real world, right now. And here's the kicker. History tells us that when these gaps between market perception and economic reality finally close, they don't do it gently. They snap shut. Think about 1929. The market peaked, and just 55 days later, the crash was on. The lesson here is simple. When the market finally wakes up, it tends to do so all at once and violently. Now let's get to our first strategic signal. For this, we have to follow the real money. I'm talking about what the ultimate insiders, the C-suite executives, are doing with their own personal capital. Because what they do tells a very different story from what they say. So the story they're telling you, the public story, is one of supreme confidence. Companies are buying back their own stock at record rates. The message is, our shares are cheap, we're all in. But here's where the story completely flips. Behind the curtain, the very same executives who are authorizing those billion-dollar buybacks with company cash, they're turning around and selling their own personal shares right into the very buyback demand they just created. And listen, we are not talking about small adjustments to a portfolio. The CEO of the largest bank in the United States just dumped $150 million worth of his stock. That's not a transaction. That is a message. So let's be crystal clear about what this means. Insider selling is now at a 20-year high. Corporate cash isn't being used for innovation or expansion. It's being used as exit liquidity for the people who know the company best. It is, without a doubt, a massive vote of no confidence from the most informed people in the market. And here's why this matters if you're managing real capital. If the people with front row seats are quietly selling and you're buying, you have to ask yourself, what do they know that you don't? Which leads to the next logical question, right? If the insiders are heading for the exits, what systemic risk do they see coming down the pipe? And that brings us to signal number 2, which frankly is about the very foundation of the banking system itself, the quality of its collateral. Now, to get this, you just need to understand one acronym, CMBS, Commercial Mortgage-Backed Securities. Just picture giant pools of loans on things like office buildings and shopping malls, all bundled up. These bundles are core assets sitting on bank balance sheets everywhere. The entire system is built on the assumption that there's safe, stable collateral. Well, that assumption is being seriously challenged. The delinquency rate on these CMBS is now pushing 7.5%. That means a growing number of loans inside these safe bundles aren't getting paid.
This isn't a future problem. It's a direct attack on the value of bank collateral today. And the chain reaction here is frighteningly simple. 1. Commercial property loans default. 2. The CMBS bundles holding them get their value slashed. And 3. The balance sheets of the banks holding them are immediately weakened. This is a slow-motion wreck happening right out in the open. So here's why this matters if you're managing real capital. Systemic risk is the one thing that's never priced in until it's too late. The market runs on the belief that the banking system is sound. The moment that belief is questioned, everything, and I mean everything, can reprice lower almost overnight. All right, let's add the contrarian layer. Because I know what everyone's thinking. If things get bad, the central banks will just ride in and save the day. They always do, right? But what if this time is different? What if this time they're trapped? And the obvious question is, why can't they just fire up the money printers again? Why not just flood the system with liquidity, plug the holes, and keep the party going?
Because for the first time in a long time, they're facing an impossible choice. Look at this table. Option 1, inject liquidity. Sure, that will support asset prices, but it will absolutely debase the currency. Option 2, tighten liquidity. Okay, that will support the currency, but it risks completely breaking the asset markets. Pick your poison. There are no good choices left on the menu.
And this trap is being squeezed tighter by really brutal fiscal reality. The US government is now spending more money on interest payments for its debt than it does on the entire military budget. Just let that sink in. They literally cannot afford higher interest rates, which boxes them in and all but forces their hand toward that currency debasement path. So let's pull all these threads together. This is great information, but how do we turn it into a usable framework? How do you actually position yourself in an environment this tricky? Okay, here's the core takeaway. The system is now forced to trade long-term solvency for short-term liquidity. It's kicking the can, but the road is running out. Now, the key signal to watch isn't what central bankers say, it's what they do. And right now, central banks around the world are buying physical gold at the fastest clip in 2 years. And that gives us our mental model, the divergence trap. Every single asset you look at, you have to ask yourself, is its value truly supported by the real economy? Or is it just floating on a tide of liquidity that's about to go out? Look, this isn't about predicting the exact day this divergence snaps shut. It's about giving you a positioning framework, a new lens to see the market through, so you can spot the growing fragility and separate real value from dangerous risk. All right, before we wrap this up, before we depart, remember, the financial landscape is constantly shifting. The insights shared here are for educational purposes only. They do not constitute financial, investment, or legal advice. Every investor's situation is unique, and you should always consult a certified professional before making major decisions. Our goal is to help you identify the signal, but the final move is always yours. Stay sovereign, stay informed.